Welcome everyone to the Money Show Virtual Expo. Today's speaker, we have Dr. Ellman, is the president of the Blue Collar Investor Corporation and author of best-selling books on covered call writing and selling puts. He has produced several DVD programs, published hundreds of articles and videos on this subject. Dr. Ellman's fourth book, Stock Investing for Students, is required reading at several colleges. He is also a national speaker for the Money Show and Traders Expo, as well as an educational contributor to NASDAQ.com. Thanks so much for being here, Alan. The floor is yours.
Thanks, Zach, and welcome everybody. I've been trading covered calls now for more than 2 decades. And what I'm going to be showing you in my presentation today is a very specific, user-friendly, time-efficient way to approach covered call writing. Now, I don't have to tell you that we've been in a very challenging market environment since the beginning of the year. So what I'm going to do today is show you a very unique presentation because you're going to be seeing how I decided on what securities to enter into this particular portfolio. And I have several at every point in time, but this one in particular I thought would be a good presentation given the current market conditions. So you're going to be seeing my decisions on how to enter your trades, entering them, managing the trades, and then getting final results. Now, pretty much everybody's portfolio is down for the year, and this one is no exception. But I want to show you the relationship between this particular portfolio results and the overall market. And therein lies what I want to get across to you is what covered call writing can do for us and why we should beat the market on a consistent basis. Now with me today is Barry Bergman, BCI Managing Director, and Barry is available, and please take advantage of this, to answer all of your questions in real time in the chat box. So put your questions in the chat box, Barry will respond to them, and he can get dozens and dozens of questions answered while I'm presenting the PowerPoint, because I don't think we're going to have much time at the end for Q&A. If there is, I'll be happy to stick around for that. We're going to be using a real-life example from one of my portfolios, which started out at the point that you're going to see me beginning with $100,000. We're going to be using exchange-traded funds known as the Select Sector SPDRs, and let's get started. Now, the trades you're going to be seeing today were appropriate at the time that I entered them after the third Friday in December 2021. They may or may not be appropriate today, so take these as educational tools only, not as advice. Let's start with the very basics. What is covered call writing? Well, this is a strategy where we buy a stock or an exchange-traded fund in 100-share increments and then sell options against those shares, generating a weekly or monthly cash flow. Now, for every one options contract that we sell, we must first own 100 shares of that underlying security in order to be covered or protected. So when we go on to our platform, after we purchase the shares, we then go to the option section and look for sell to open. That's how we establish our covered call trade. We sell the option to open a position. It may say STO. Now, our contract obligation is to sell our shares that we either just purchased or already had in our portfolios at a price that we determine, which is known as the strike price, by a date that we determine, known as the expiration date. You're going to be seeing a monthly contract for the January 2022 contracts, and the monthly contracts expire on the third Friday of the calendar month at 4 p.m. Eastern Time. Now, weekly contracts expire every Friday at 4 p.m. Eastern Time. Now, because we are undertaking a contractual obligation, we get paid, and that premium is what we get paid. And if we were going to summarize everything from the perspective of option buyers and sellers, the simple sentence would be option buyers have rights. They have the rights to buy the shares at the strike price by the expiration date, And option sellers have those contractual obligations. And in return for undertaking those obligations, we are paid cash. Let me give you a preview example before we go into the actual real life examples. We buy 100 shares of a company, let's just call it XYZ. I hate that company, but it's just a hypothetical, at 48. So our investment is then $4,800. Now we are covered or protected. We then sell the option. We're selling that unknown person the right, but not the obligation, to buy our shares in this hypothetical for $50. Remember, we bought it at 48 at any time during the next contract month. We are then paid a cash premium. Now, a typical premium would be $1.50 per share or $150 for the contract. If the underlying security is less volatile, we would get a lower premium. If it was more volatile, we would get a higher premium. Now, this is for traditional covered call writing. You're going to be seeing blue chip ETFs, which will return a slightly lower premium. But this is for traditional covered call writing. If we generated $150 selling one contract in this hypothetical, that would represent a 3.1% 1 month return. And if we could do that every month, it would annualize out to 37%. Now, there are two major possible outcomes with setting aside exit strategies for the moment at the end of the contract month. Let's assume for a moment that the price of XYZ never supersedes the $50 agreed upon sales price. It remains under. Well, our shares would not be purchased. The option buyer is not going to elect to exercise that option and buy our shares for 50 if it's trading at market at 48 or 49 or any other price under 50. So what happens? The option expires worthless. We keep the $150, and that means we've generated a 3.1% 1 month profit on the option side. We still own the shares, and now we're free to sell another option for the next contract cycle. The second possible major outcome is the price of the stock does in fact move above that $50 agreed upon sales price, and we take no action. Again, we could always buy back the option and prevent our shares from being sold, but let's assume we don't do that. Well, then our shares are purchased at 50. We now make an additional $200 on the sale of the stock. Bought it at 48, sold it at 50 times 100. Our total 1 month profit is $350 on a cost basis of $4,800. That represents a 7.3% 1 month return. So that's the second possible outcome. Now let's get into the specifics of this particular strategy where we have a database of only 11 securities. Those are known as the Select Sector SPDRs. What are they? Well, these are exchange-traded funds that divide the S&P 500 into 11 sector index funds. Now, they have the diversity of a mutual fund, but they trade like a stock. You can buy and sell them during the course of the day, and many of them, all of these Select Sector SPDRs, have options associated with them. Not all exchange-traded funds, but the 11 I'm talking about today all do have options associated with them. As a whole, these 11 sector SPDRs represent the entire S&P 500. Now, each sector can be bought individually, and in this particular case, what we're going to be doing is we're going to be purchasing the best performing Select Sector SPDRs at the beginning of each contract. I'll show you how to do that. Now, as you know, these institutional investors rotate in and out of sectors. So we're going to locate the ones that are in favor at that point in time, and those are the ones that are going to be in our portfolio that particular contract cycle. On this screenshot, you see the 11 Select Sector SPDRs. No need to read them all to you, but you could see that they include energy, financials, technology. So if you took, for example, the one all the way at the bottom, utilities, XLU, that would include all of the utility companies in the S&P 500. If those are in favor with the institutional investors, then I want them in my portfolio that particular contract cycle. Let me give you an overview of today's webinar. We're going to be funding a covered call writing portfolio with $100,000. I did that after the end of the December contracts 2021. leading into the January 2022 contracts, I put $100,000 into this portfolio really to create a portfolio which is very easy to navigate, very easy, and very time efficient for retail investors. We then locate the best performing select sector SPDRs. I use 4 each month, the top performing 4 each month. We're going to allocate for this particular contract 25,000 per position, 4 into 125. We're going to make sure that we leave aside, we don't use 2 to 4% of that portfolio so that it's available for potential exit strategy opportunities. Of course, to initiate any exit strategy, we must first buy back the option. Where's that money going to come from? It must be in our portfolio when we establish that particular contract portfolio. Okay, once we have our positions, we're going to check option chains to see if we can generate the premiums that we established in our goals. That must be stated ahead of time. A realistic goal for monthly options on the select sector SPDRs would be between 1 and 3%, usually more like 1 to 2%, but certain ones will actually generate up to 3% initially. Now, the Monday after expiration Friday, we're going to buy these ETFs, sell our options, and then we're going to set 20% buy to close, good to cancel limit orders. I'll explain that as we go along. But what that does is by setting these buy to close limit orders, it protects us if the share price should decline substantially. We automatically will buy back the option, and that will put us in a position to mitigate these losses. So we'll show you that as we go along. We'll manage the trades if needed. There were some exit strategies maneuvered you will be seeing today. And then we'll calculate our final 1-month results and compare it to that of the S&P 500. The S&P 500 started after the expiration of the December 2021 contracts at 46.21. It's not there today, for sure, but that's what it was when we started. Now, for those of you who are premium members of the Blue Collar Investor, the ETF reports are located on the left side of the member page where you see that red arrow. We have the most recent 5. You're gonna want to use the one that's the most recent when you're setting up your portfolios. And this is one of the pages of the report. Now, the top portion is our ETFs in general, but the middle portion where you see that red arrow, those are for the select sector SPDRs. And we list the ones that have outperformed the S&P 500 in 1 month and 3-month time frames. We also have 1 week, but we don't factor that in terms of sorting. So the middle section are the select sector SPDRs in our reports. But you can also use various tracking software, or there are certain sites where you can get the results. In this particular case, this was taken on December 19th, 21. So right after expiration of the 12/21 contracts, and therefore the January 2022 1-month expirations. Very top, you could see at that point the S&P was down 1.45%, and we selected the ones where you see the red arrows, P, V, RE, and U. They all start with XL. And those all were in the green at that point in time, and those were the 4 best performing select sector SPDRs. Consumer staples, real estate, utilities, healthcare. Now, we have to set up a spreadsheet. We want to allocate a similar amount of cash to each position. Here's how you do it. You put in cash allocation per position, 25 grand. Divide the price per share into 25 and you'll come out with a number. For XLP, it was 332. Well, we know we do this in 100 share increments. So we round that up or down, in this case down to 300, which means we're going to sell 3 contracts. And we do that for all. Now, this is the initial setup because it doesn't always work out. It didn't in this case. So 357 was rounded up to 400. But look what happened. If we were to do the math, that would come to 103,174. We only had 100. So we were in the red by 3174. Plus, we had no cash for exit strategy maneuvers. So what do? Well, what I decided to do was to round the 357 down to 300 instead of up to 400. That worked. That means we spent 96,174, and that left us a cash reserve of 3,826 for exit strategy maneuvers. Perfect. Now, the weekend before Monday, before we take any action, we just want to make sure that we can generate our 1 to 3%. So we look at the option chains from market close on Friday, and we put in the out of the money strikes higher than current market value. XLP, for example, 75.21, we put in the 76 strike, that generated 78 cents, 1%. That just made it to the lower end of our goal. But there was an opportunity for another 1.1% if XLP went from 75.21 up to the 76 strike. XLRE had a combined possibility of 3%. So all of these did meet our requirements, 1% to 3%. Now here are actual screenshots taken from my brokerage account, no monkey business here, and on 12/20 when I entered my positions. Now you could see I actually made a mistake here with XLU. I forgot that I rounded down instead of up, and I initially bought 400 shares, but I went right back in and sold 100. So no harm, no foul. And I purchased those shares at the price on Monday, which isn't going to be exactly the same price as when we went through it over the weekend. I then sold covered calls. Here are screenshots for XLP and XLRE. XLP, I sold the 75.50 calls for $77 a contract. There were 3 contracts, so that was 230 some odd dollars, or maybe $40. And then I set a buy to close limit order at 20% of 77 cents, 15 cents. XLRE, I sold the 50 calls at 60 cents, 5 contracts, right? So that's $300. And I set my buy to close limit order at 20% of 60 cents, 10 cents. They wouldn't accept, they only do them in 5-cent increments for XLRE. Come as close as you can. Here are screenshots for the option sales on XLU. Same thing, $89 a contract. And then I set my buy to close limit orders at 20%. And XLV, I sold at $2.20. So $440 was generated into my account, and my buy to close limit order at 44 cents at the bottom. Remember that number. Let's show you a summary of our trades now. We bought 300 shares of XLP, 74.19, 500 shares of XLRE, 48.83. This was based on our asset allocation formulas. 300 shares of XLU at 68.51 and 200 shares of XLV at 135.83. Then I sold my options. The 75.50 added the money strike compared to 74.19. Set my buy to close limit orders, and I did the same thing for XLRE, XLU, XLV, all the buy to close limit orders. Now, when you do a buy to close limit order, also enter it as good till cancel, not day only. This way it will stay there until you change it. So you don't have to go back in each day and set a buy to close limit order. You could just put it in as good till canceled, and it will stay there until you let the broker know otherwise. What I do is I make a note on my calendar, you see at the bottom of the screenshot, to change that 20% buy to close limit order to 10% on the weekend prior to the last 2 weeks of a monthly contract. And the reason for that is, as time goes on during a monthly contract, it becomes more and more difficult to generate additional time value premium as we mitigate and enhance our returns. So we're only willing to spend a certain amount of money, in this case less money, to close our short call positions. So 20% at the beginning of a contract, 10% the last 2 weeks of a monthly contract. Now here's the activity. Again, you're seeing screenshots taken directly from this portfolio. The buy to close limit order was executed on XLV at 44 cents. Remember, I told you to remember that number. It just got executed automatically because I entered that 20% buy to close limit order instruction to my broker. I didn't take any action at that particular time. I was waiting to see if the stock rebounded. Now, the remaining 20% buy to close limit orders were changed to 10% the weekend prior to the last 2 weeks of the contract. So 15 cents became 8 cents, 10 cents became 5 cents, and then 18 cents became 9 cents. Took about a minute, that's all. It's very user-friendly, very, very time efficient. Now, what happened? I actually sold those XLV. Remember, they were closed at 44 cents. I resold them, and I used the 136.50 calls, which was lower than the original strike. That's called rolling down, but it was still to an out-of-the-money strike. So it was higher than current market value, and I generated 80 cents. So if I had two contracts of 80 and I bought it back at 44 cents, so that means that I got $72 additional premium by rolling down to that out of the money strike. Now here you see, additionally, the buy to close limit orders were executed on 5 contracts of XLRE at 5 cents. You see that on the top. I ended up not taking any further action on that one. But also 3 contracts of XLU at 9 cents over here. That was triggered automatically. And then what I did was I rolled down to the 69 strike on XLU for 38 cents. So 38 minus 9 is 29. I had 3 contracts. That was an additional $87 of premium that I generated into the account. Now what happened is XLP, the option ended up expiring in the money, and that means my shares were sold at 75.50. So that happened the day after expiration Friday. So here's a screenshot now of that account taken directly from my brokerage account. Now you could see the account value actually declined from 100,000 to 99,615. So I lost about $385. Now, folks, I'm not here to tell you that losing money is a reason to break out the champagne. However, I am telling you that it's not necessarily a reason to break out the Kleenex, because you could see here that particular, at the end of that contract, I still had positions in XLRE, 500 shares, XLV, and XLU. XLP was sold, and that was due to the exercise of those contracts. I had cash of 29,624. So the total between ETF positions and cash came to 99,615. Okay, now let's actually compare to the S&P 500. You could see again the XLP disappeared from our account. It was sold. Our actual result for that month was a negative 0.38%. So we lost less than 0.5%. We lost, but less than 0.5% of our contract value. Now the S&P 500 closed, you could check this, at 43.98. And that means the 1-month return on the S&P overall was a negative 4.83%, almost 5% down. So the covered call writing portfolio outperformed the S&P by 4.45%. Now, I've been doing this particular approach for the 5 months in 2022, one of the most challenging markets ever, right? I mean, they've been worse, true, but you have to admit it's an extremely challenging market. At this point in time, my portfolio for the year is close to a break even, slightly under, but close to a break even. It is by far my best performing portfolio in my option selling accounts. It's the one that really takes me the least amount of time to negotiate. So, and each of those 5 months in 22, I've outperformed the S&P, every single one of them. What are our next steps? Well, the weekend after expiration Friday, we do the same thing. There's nothing different. We prepare for the February contracts. We locate the elite performing underlyings. If they happen to be the ones still in our account, we keep them. If not, then we sell them on Monday and move on to the new ones. You know, we have no loyalty to these securities, none at all. We just care about the cash, period. Now, our 4 positions will allocate now, not 25,000, but slightly less, 24,903. And then we go through the process again of cash allocation. We're already diversified almost 30% of the S&P 500 if we take 4 of the 11 select sector SPDRs. Make sure we have our cash reserve of 2 to 4% for potential exit strategy executions. So let's summarize, and then I'm going to show you some of the products that you can get to master these strategies, and I'm going to be offering a discount coupon as well. For successful option selling portfolios, it's a three-pronged requirement. You must master these three approaches. Number one, what stock or ETF are we going to select? I showed you a unique way of using the Select Sector SPDRs. For more traditional covered call writing, it's different, but it's in my material. What option are we going to select? In this case, we selected out of the money options that generated 1 to 3% a month. What about position management? Very critical that after we enter our covered call positions, we then enter our 20%, 10% buy to close, good to cancel guidelines. Additional factors including establishing ahead of time our initial time value return goal range. In this case, it was 1 to 3%. Most of my portfolios are traditional covered call writing, where my initial time value return goal range is 2 to 4%. If you're more conservative, just go a little bit lower. We do cash allocation, as I showed you today, and you have that cash reserve, that requirement. Now, not all contract cycles, including the one I showed you today, will result in positive returns. What you want to do is look to see how you did, how we did, compared to the overall market. If we beat the market, we did our jobs. We should beat the market on a consistent basis, because when we sell a covered call option, we are lowering our cost basis. This is not rocket science. You do not have to be Albert Einstein to figure this out. When we sell an option, our cost basis is automatically lowered. Now, will we beat the overall market every single contract cycle? So far this year, I have. And in most of my portfolios, I have. But there will be some where you will not. Don't get discouraged. You will beat the market more often than not, much more often than not. Again, I've been doing this for more than 2 decades now. And every year, we just go by calendar year, I have beaten the market, and many years significantly. Now, in the 5 minutes I have remaining, I'm just going to show you some of the products that you may be interested in to master these strategies. In a half an hour, I can only kind of dip my toe in the water with you guys, but I am going to be offering all these products at a discount, 10% discount, using the coupon discount code Canada10. Okay, and that's good today and tomorrow, so through May 25th. Now, our best and most comprehensive package, folks, is called our BCI package, Best and Most Comprehensive Investment Package. That's the acronym. It includes 6 online video courses with downloadable workbooks, 6 calculators invented by the blue-collar investor, therefore found nowhere else, 5 of our best-selling books, and I have the #1 selling books on both covered call writing and selling cash secured puts on Amazon.com. That's included in these 5 in ebook format, and our annual 13-month premium membership, which includes all the reports for eligible covered call writing and put selling candidates, along with over 200 training videos and expanded calculators and much more. All that's included in the BCI package for $9.97. Of course, you'll be getting a 10% discount using Canada10. Now, we just introduced 2 weeks ago a new package found nowhere else. We call it our trade management system, a TMC package. And you go to that link and you can actually watch the video of what's included. But Barry and I spent a year and a half developing a spreadsheet that's the only one of its kind anywhere in the world, to our knowledge anyway. And it allows us to enter our trades, get initial calculations, adjust and manage our trades, get final trade calculations and total portfolio calculations. It's an amazing spreadsheet with over 3,000 formulas inherent in that spreadsheet. It comes with my 8th book, which was just published on exit strategies. Now, if you go to our website, thebluecollarinvestor.com, that's where the TMC package is located, and you can combine it with the BCI package. That we have a price of $10.99. You will get a discount of $109.90 off of that if you combine those 2 packages. Here's the location of the discounted packages. Go to our website, thebluecollarinvestor.com. Click on the link where you see the red arrow, and that will take you to those two packages with more information, videos, everything you need to help you make your decisions. And again, the discount coupon is good today and tomorrow. You can also go into our store and purchase items individually. The 10% discount will be good for every one of the items in our store today and tomorrow. Once again, the promo code is Canada10, and it's 10% off all items in the store, and it's good today and tomorrow. Ladies and gentlemen, that ends my presentation. It looks to me like I finished right smack on time. Zach can let me know whether I get an A, B, or F on that. And I want to thank everybody for taking the time to attend my presentation today. If you think of any questions that Barry hasn't had an opportunity to answer, you could reach me at alan@thebluecollarinvestor.com, or you could reach Barry at thebluecollarinvestor.com. And once again, our website is thebluecollarinvestor.com. I want to thank The Money Show for inviting me to speak here, Zach for making all this happen from a technical vantage point, Barry for assisting me with questions, and most importantly, you for taking the time to attend my presentation. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.
Alan, A+, thanks so much for the presentation. Very informative. We've got more content coming up, so stick around and we'll be back shortly.